The three-step test that finds winning stocks fast and avoids crashing stocks.
Frustrated by drawdown? Struggling to keep your investment growing? Well, in this video, we uncover a remarkably simple technique that enhances returns and reduces drawdown. Whether you're a passive index investor or a more active trader, the simplicity and effectiveness may surprise you. As traders, we often look for complexity in order to solve the markets, me included. However, in this video, we demonstrate precisely the opposite, leaving many wondering why they've not applied the technique themselves. Before we get into the detail, let me show you some of the major market declines which were avoided. Let's start with a dot-com bubble in the year 2000. Using the S&P 500 as our benchmark, we can see how the index dropped by more than 50% from its peak. Our simple rule would have seen us exit the market here, whilst re-entering after the market bottom. The drawdown, misery, and even opportunity cost during this period would have been significant. In some situations, the losses were sadly too much to bear. A similar situation occurred in 2008, widely referred to as the Great Financial Crash. Again, using the S&P 500 as the benchmark, we can see how the market dropped by a near 57% from its peak. We would have exited here and only re-entered after the market bottom had occurred. Can you imagine losing more than half of your investment in just over a year? Or perhaps even worse, being just moderately leveraged would have seen many lose everything.
And not only that, this doesn't apply back decades ago. This can apply today, on the market today, right? Because what we're talking about here is the 10 EMA under the 20 EMA, which would have got you out of the market on this crossover right here, right? The crossover happened right above it. So this candle right here on February 25th. And since this point, what's happened to the market? Since this point, it's gone down only 17% so far, only 17% so far. And then if we go back, let's go back to COVID, right? I don't know if this video was made before or after COVID, but we can go back to COVID and see the exact same example once again. The 10 under the 20 happened right on this candle here on February 24th of 2020, right here. And then it went down and down and down and down, right? Peaking 32% down from this crossover point here. And then if you want to look at where they crossed back up, actually would have been about right here. And you can see just how much it ran since that point. Now, this is what I'm trying to get you to imagine, is that you never have to take big losers again. You never have to hold a stock like Nvidia all the way down again. Because look in the blue and black lines. When did they cross? They crossed up here. So basically this candle right here on October 30th of 2024, and has not crossed back until March 25th, and it was just a blip over under. Like I say, you might make a buck, lose a buck, but then you'd be out of it once again. And in this process, AMD has gone down 50%. So what I'm trying to get across to you here is that this is not theory. This is reality. This is not just something that's cool in a textbook. This is something that's cool in your portfolio today. It's real cool. It's ice cold because it works. Because it works, it's just math. And it's timeless principles, which is why I can put my name right on this, and you can write it on my tombstone, that the 10 over the 20, price over the 50 is a bullish trend. The 10 under the 20, price under the 50 is a bearish trend. You throw those three things on any single chart and it will keep you in the direction of the trend. Sometimes it might chop you up a little bit, but it'll keep you in the direction of the trend for as long as you need it to go. So when I found this video, I was like, this is perfect. So let's continue on.
How about in more recent times? In 2022, financial markets became fearful from the events in Ukraine and the resulting rise in inflation. The S&P 500 took a volatile move down, losing around 27% of its value from the peak. In fact, many funds, including the likes of Cathie Wood's ARK Innovation, lost in excess of 70%. However, using our method against the S&P 500, we would have exited the equity markets, including Cathie's fund, here, and only re-entered early in 2023, saving us again from considerable drawdown, heartache, and opportunity cost.
I do want to point out that Rick says he's using weekly charts in the SPY, and that's the cool thing about this. You can put this on the weeklies, you can put this on the dailies, you can put this on the 5 minutes, you can put this on the 1 minute, and it'll show you the direction of the trend. This is the 5 minute chart today. you can see it gapped up and then it trended down all day long. You can put this on the 1 minute. You can see when it's trended down, when it's come up a little bit, a little sideways, and then back down. You can put this on the hourly. Same thing, right? And that's the great thing about this, is that it applies to all time frames. This is why I will tell you to do this for the rest of your life.
The method we use? It's the 10 and 20 exponential moving average crossover. It sounds a mouthful.
Now, of course, I add a little bit more to it, the 10 over the 20, price over the 50, but dude is so on the right track. I mean, we're basically on exactly the same track. He might be driving a Formula E car and I'm driving a Formula 1 car, but we're on the same track.
But its application is very simple indeed. Before looking at the method, longer-term returns, and the impact it has on my own equity curve, please consider hitting the like button. And for those new to the channel, why not subscribe to our growing stock market content? Ranging from singular strategies through to research studies, I also offer my own strategy born from over 30 years of market experience, as well as an active forum and a bespoke breakout scanner. Let's look at the crossover method in action. On almost all charting and brokering packages, you will see an option to add many indicators. And in this example, we select the exponential moving average indicator. We're then presented with an option to add our settings, and we add 10 and 20 into each of the boxes. We apply this to the S&P 500 weekly chart and get the following presentation. We can see the dot-com period, and not far from the peak, we get a confirmation of the 10-week moving average crossing below the 20-week moving average, marking a great time to exit the equity markets. An exponential moving average is a line that measures the average movement of price over a set period, smoothing out much of the noise, without the need to look at the price action. Throughout our method, we use the weekly chart. Therefore, the 10 EMA measures the average price movement of the previous 10 weeks. Unlike a simple moving average, however, the exponential moving average places more importance to more recent price movements, therefore helping us to react faster. Using a moving average crossover means that we can have a mechanical method of entering or exiting the market, regardless of news or the noise of price action.
Oh, this is perfect. Yes. So it'll get you out of the market when things are going bad. And then, like I say, every once in a while, you might make a buck or lose a buck. Sometimes the trends can flirt with each other, but then you're out of the way again, but then you can get the new buy signal and then ride it back up. Isn't that cool? So like I say, you might have lost $1. Well, let's say you got out here, maybe across this way, you'd made 20 cents. No big deal. And you're probably like, oh, this guy, Chris, doesn't know what he's talking about. And then he comes up on the other side and you're already up 10 bucks. You didn't lose $100 on the way down. You might have made 20 cents overall here. And then you've already made 10 bucks over here. That's how trend trading works, right? Occasionally you're going to get stopped out here and there, but when you're on the right side of the trend, you are there for the long haul. And same thing if you're going short, you can be there for the long haul. This is so cool, right?
Imagine how much calmer you would have been during both the dot-com bubble and the great financial crash by simply
and the 2025 tariff trade crash.
Using the method. No huge drawdowns, whilst still benefiting from the bulk of each recovery. Let's put all of this together before we move on to some backtest analysis. Firstly, we use the S&P 500 index whilst viewing it on the weekly time frame. We overlay the 10 and 20 EMA indicator, and we look for the crossover in either direction. We then have two choices. We can either buy into or exit the index based on the crossovers. Or we can associate the crossovers with a trading window, therefore only applying a strategy when we get confirmed trading windows.
Which is what I do. Which is exactly what I do. Which is why I'm waiting for confirmation before I'm getting in. Which is why the master key starts with, where is this? Here, market trend. Market trend is so critical because a rising tide lifts all ships, but a falling tide shows you swimming naked. And you want to be on the rising tides and not when it's swimming naked. So that is why, for me personally, I will sit and I will wait in cash as long as it takes to get this confirmation, and then I'm interested in going in, right? And I want to see it not just on the SPY, but I also want to see it on the individual chart, because we want the momentum working with us rather than trying to think we're geniuses, trying to catch every bottom. But in the meantime, we're getting worse and worse and worse, losing more and more and more, watching our portfolio evaporate day after day and wondering, what are we doing wrong? You're trading against the trend. That's what you're doing wrong.
Either approach has proven to be very beneficial. However, let's start with a backtest of buying and selling the S&P 500 index first. To demonstrate how effective this approach is, we should first understand how difficult it is to beat the index. Remember, the S&P is made up of the 500 largest companies in the US. A recent study by Forbes determines that actively managed funds, including pension funds and mutual funds, were largely unlikely to outperform. In fact, over a 10-year period, only around 8% of funds would beat the index. If, however, the 92% of underperforming funds were simply to use this crossover method, they would have been considerably ahead. The blue equity line represents account growth from buying and selling the index at the crossover. The orange line is a simple buy and hold approach. It's a shame we couldn't go back further than 2002 to cover the dot-com crash. In doing so, we would have seen an even bigger improvement. The main observations from the backtest is the avoidance of drawdown in 2008 and in 2022. The crash due to the pandemic was hard for any strategy to avoid due to its speed. Nonetheless, the largest drawdown was 24% over the backtest period, less than half of that of the buy and hold approach. And for an index that is statistically hard to beat for the most highly paid fund managers, it fared very well.
In fact, most fund managers could just buy the SPY, do this simple strategy, and outperform the SPY. That's what he's saying here, right? These geniuses who are getting paid millions and millions and millions of dollars to just, outperform the SPY by a couple basis points. By doing this, they could outperform it by many percentage points. And in a year like this with the Trump dump, the SPY is taking a huge dump and they could be sitting in cash the whole time. And then you've got these jokers on the YouTubes who want to tell you to buy all the way down. And they're the ones who are getting wrecked. Well, they're the opposite of you. They're the opposite of you because you've been sitting in cash, hopefully, because you've been listening and understanding why we're sitting in cash and we're not stressing about the market. And it just makes life so easy. It's so much easier to sit in cash rather than sit in any of these stocks, right? Let's go see. It's so much easier to sit in cash instead of sitting in any of these stocks because cash is a risk-free position and cash is a trade. Stocks like Apple, who you'd never think can go down 5% in a single day. And if we change this to a week, down 22% this week. Nvidia down 13% this week. Amazon 11%, Google 7%, Meta 13%, Tesla 17%. All of these stocks used to be the ones that you could buy and forget about. And I think people forgot all about risk. But had they just added a couple moving averages to their charts, and Tesla's such a perfect example. If Tom Nash had added these to his charts, Tom Nash would have been able to get in on the crossover right here, ride it all the way up, and then get out right, not too far from the top. Let's say about 15% from the top. Now, this is a 100% move up, by the way. The price doubled during this time. You would have kept basically 85% of it, and then you would have avoided this enormous drawdown and completely round-tripped. How many times have you round-tripped a stock? Good news is you never have to do it again. That was the last time, because it ain't going to happen again. Now that you know this. Now that you're an outlier.
Such an approach could just be a foundation to build upon further. For example, if we also added in a 12% trailing stop to the crossover approach, the performance would be enhanced further. More noticeably, the reduced drawdown of
a 12% trailing stop is enormous, by the way. That is a tremendous trailing stop.
16%. It's quite feasible to suggest that with a low drawdown, you could apply leverage to the approach. If, for example, you are willing to accept twice the drawdown, you could consider a leverage factor of 2 to 1, therefore doubling the annual returns and significantly improving the compounding effects. The reason for my analysis, however, was to improve upon my own breakout strategy. In light of 2022 and the market's erratic move down, I wanted a broader market timing model which would offer the right environment to apply my approach. We can see here that the 10 EMA crossed below the 20 EMA early in the year and never crossed back up until early 2023. It's a simple timing model that provides windows of opportunity to apply strategies, and of course, periods when we should not. Avoiding drawdown is, of course, only one part of the equation. I also wanted to determine if the timing model had any negative impact on my strategy as a whole. The impact was pleasingly minimal. Other than a slight variance from a small batch of trades, the broader market timing model all but eliminated the 2022 losses, remaining in cash for the most part. Needless to say, the PDF has been updated to include the model. For those interested in the crossover approach as a standalone strategy, let's revisit some backtest studies. How about the Nasdaq? Well, buying and selling at the crossover would have meant outperformance over a buy and hold approach, not with the same degree of safety as using the S&P, but nonetheless outperformance. Again, it's unfortunate the backtest was limited by date. Had we seen a dotcom crash, the outperformance would have been huge. We can, however, see the crossover in action during the crash. We look for the 10 and 20 EMA crossover on the weekly Nasdaq chart, and by doing so, we would have been in the index on the way up and out of the index for the bulk of the move down. How about FANG stocks? FANG stocks are comprised of the 5 most popular tech companies, and in this backtest, we use 20% against each of the 5 stocks, whilst again entering and exiting on the 10 and 20 EMA crossover. We can see the average annual return of 17.3% over the 23 years, with a maximum drawdown of 32%, an improvement on the 66% drawdown we would have seen if we simply held the Nasdaq over the same period. The 100,000 investment would have turned into 2.6 million, way above buy and hold. Aside to a standalone approach, for me the revolution is within its simplicity and the ability to provide a timing landscape in which to apply a trading strategy. By avoiding the application of a long approach in the red areas when the 10-week EMA has crossed below the 20-week EMA, we greatly improve the probability of success. Similarly, if you applied a dollar cost averaging approach against the S&P index, you might want to only add funds during the green windows and return to cash during the red. Regardless of your preferred approach, it's not only the cost of drawdown. It's the psychological impact and the opportunity cost of tying capital up for prolonged periods.
And that's a huge part of it. I'm glad he mentioned it, because most people don't want to consider this part, right? They don't want to consider the fact that I bought a stock, and let's go to AMD. I always love to use AMD, which is now a $77 stock, by the way. I bought a stock like this, and I'm just going to hold it. I'll hold it until it comes back, right? Well, how long is that going to be? We don't know the date when it's going to come back, right? We have no idea. So you could be potentially looking at 6 months, maybe even 6 years to get your money back. And that psychological aspect of it is going to eat you away day after day after day. I know, and I tell you this all the time, is that all stocks are bad. Every single stock is bad, but every once in a while they act right. You need to be looking for them when they're acting right. And you can do that by applying the trend template, which is the 10 over the 20 and price over the 50. That's your trend template right there. Now, there was a question in the chat. I think it's a great question because I get this question all the time. And that is, the biggest issue is the short-term stuff is nearly a 35% short-term tax versus 15% long-term tax. Let's consider Tesla. Right? I would much rather have more money in my account. Right? Let's just do the math here, okay? If I was able to get in and then get out on this 10-20 crossover, right? In fact, let's even do it right here. On the 10-20 crossover, that was a 66% gain. So if I had a $100 stock that went up 66%, so that would mean I made $66 in profit, which is pretty awesome, by the way, outstandingly awesome. So now I have $166 in my account. I'm not paying taxes on all of this. I'm only paying taxes on the gains, right? And so in your example, let's do this. This times 0.35. Okay, so I'm going to owe $23 in taxes on those 66. That kind of sucks. I agree. But you know what sucks worse? Is going from $100 in my account up to $166 in my account. And even if we take out the 23, let's say this plus this minus this, I still have 142 in my account. But if I never sold and I round tripped it all the way back down, I am not in a better situation. Not at all. In fact, I'm probably in a much worse situation because mentally, I just blew it. I just blew this enormous move. I could have got out, held my cash, kept my profits, and paid my taxes, and had more money in my account. So it's the equivalent to this. Imagine you want a promotion at your job. Imagine you wanted to get a job that paid $166,000 and you're making 100 right now. And you go through all the effort, the interview, the rigmarole, and you get the new job. They offer it to you. They say, John, congratulations. You're now going to be director of sales, whatever the case is. Congratulations. Your new job has $166,000 salary. And you look at them and you're like, that means I have to pay more taxes. Nah, not worth it. I'd just rather keep my old job. It's the same thing. It's the same thing. I don't want to pay the taxes. I would just rather keep what I'm at. Or worse off, not paying the taxes and ending up losing your original investment. So now, not only would you not have 166 in your account, minus your taxes at 142, you might be down to 90. Or if you're an A&D investor, might be down to 78. I mean, you're not paying taxes on that. But if your goal is to just not pay taxes, there are probably lots of other ways to do it than watch your money evaporate. So it's a great question. It's one I get all the time. So don't stress about that. But the point is that you want to maximize your gains while they're coming and forget about the taxes. If you are paying taxes, that means you're doing something right. Paying a lot of taxes is a byproduct for being a kick-ass, bomb-ass, making all kinds of money-ass trader. And I can consider myself in that. I think that's a great place to be. You know what else is a great place to be? Is to go and read this book right here, New Trader, Rich Trader. In fact, if you have your copy of New Trader, Rich Trader, and you went over to page 106, which I happen to have on the Kindle right here, the Kindle page is also page 106. You'll notice right here, he says he would only trade his system when the S&P 500 chart had the 10-day moving average over the 20-day moving average, and the price of the S&P was above the 50-day moving average. I'm telling you guys, 80% of what I do is in this book right here, because I learned directly from Steve. So that's your 3-step test that I want you to take away today. Add onto your charts, and this is not the first time you've heard it, and this is not going to be the last time you've heard it, but it does reinforce the fact that you can trade with 4 potential outcomes: a big win, a small win, a break even, and a small loss. And it will avoid the 5th potential outcome, which is a big loss, but you never have to do again. And in fact, this is a great point. If you don't want to pay taxes, just trade in your IRA. Yeah, great point. Outstanding point. I did see a question in the chat that I wanted to go back to. Taylor asks, new time beginner. Cheers. Thanks for coming. Just watching through your videos and learning. When the price crosses over the 10, 20, 50, but sometimes the next day it comes back down. Yes, this is the exact question I wanted. When that happens, AMD is a absolutely perfect example. First off, you're never going to catch 100% of the moves. I'm sorry. Let me rephrase that. You're never going to catch 100% win rate. It's never going to happen. Not ever today. And in fact, this is a perfect example, right? Here, the 4 possible outcomes: big win, small win, break even, or small loss. This would have fallen into the small loss category, and that's okay. That's okay. But you know what it did avoid? The big loss. It avoided the big loss, which in fact, from this point right here, from this point just right here, 31%. In 10 days. AMD is down 31% in 10 days. This has got to be eye-opening to you guys. If this is making sense in the chat, I want you to type 10 in the chat for 10, 20, 50, right? Type the number 10 in the chat if this is making sense to you. Now, I know we're going long today. We've got a ton to cover, right? But let me introduce myself real quick. I know I'm just some random guy on the internet. Hang on, where's it at? But my name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And of course, if you haven't gone to the outlierdeal.com, you need to real quick. We've already got, how many? You're not going to believe this. We already have 2,792 entries. Let me refresh the page. It's going to be even higher. We have 2,903 entries. This is crazy. So like I say, Top prize is $1,000 and a free year of Outlier. First runner-up gets $200 of merch and my 5-book bundle, my 5 favorite trading books. And second runner-up gets $150 worth of free merch and the 5-book bundle. So be sure you go and do that real quick. And of course, today's secret code is winner. Now, this is new, and I want to show you what you're learning, right? I want to showcase what you are learning in these videos. So some of these videos is basically just going to be me ranting about how stupid some people are. But in this video, there's actually quite a lot to learn from. So tell me in the chat, what did you learn from this video, right? Checking this up. I'm seeing lots of 10s, 10, 20, 50, OPP. Hell yeah, long stream. Let's go. Hell yeah, this is literally my day job, so I'm good for this. Rando guy. Nathan, no 7s, no 7s. We got all the 10s. Everybody's understanding just how important this is. But tell me in the chat, what are you learning from this particular video? If you don't want to pay taxes and stay in cash, that's a great point. That's a great point. Richard says, you can go along anytime you like. You're the only podcast that makes sense. Okay, I like that too. From 102 to 1104, as soon as AMD crossed over 110, it was bye-bye for me. Very cool. I learned that we still don't rate videos. That's not justification for paying short-term versus long-term tax gains. Okay, listen. If I can't convince you that you need to trade with the trend, by all means, there's lots of channels out there that'll tell you to just buy the dip and never sell. So that's probably a better place for you. And by all means, go enjoy those videos. You don't have to watch these. But for those of you who do want to learn, just come on over here, right? Come on over here. But yeah, tell me in the chat what you learned from this video. And of course, it's your choice, right? You can be lame and go to these other channels, or you can do what we talk about here and change your life. You can do what we talk about here and change your life. Jonathan says he's done with the hype train. I learned that we are on the right track. Absolutely. Sit in cash. And that's the plan. That's the plan. Absolutely. Let's go to today's member highlight real quick over in our Discord. So in our Discord, we have a couple spots. So first, the Q&A questions from you. Let me see here. This was it. Okay. First question. I believe we talked about this the other day. Mentioned be risk first by making sure that we get out of trades instead of holding on to them. Right. When do you know it's the optimal time to get out? Thanks in advance for your answers. So for me, I have many, many exit signals, of course, and I'm looking for the absolute least amount of risk in my trades. First, the 10 EMA. If the 10 EMA is broken, I'm out. If the 10 EMA is broken, I'm out. So what does this look like? Let's look at Meta. Right? When the 10 EMA is broken, this is a great example. Right? As it's rolling up like this, you can hold it all the way up, and then you can get out when it crosses under the 10 EMA. Now let's do some math here on some taxes. Since that was brought up today, let's do it, right? Here's the green light over here. The 10, 20, 50 are crossed up, and it closed above the 10. And it went up and across under here would have resulted in a 14.9% gain, an $86 gain. So it went from 617 up to 705. Okay, since we want to talk about taxes today, let's do it. Went from 617 to 705. So I'm not going to pay taxes on 705. I'm only going to be taxes on the gain, which in this case is this minus this. And then if we use the 35% tax rate, which was the example, times 0.35, that means I'd have to pay $30 in tax on this. That's okay. But still, I would have more money in my account today than if I hadn't sold. In fact, if I hadn't sold, my investment at 617, oh, wait a minute. Oh, yikes. Oh, no. Oh, this is not good. Oh, this is not good. If I didn't sell out, because the very first time it closed under the 10 EMA, by the way, the very first time it closed under the 10 EMA, it went down like this. Now you've got a bearish trend, so I wouldn't even consider buying it as it crossed over right there. It's now down to $510. So if I were to look at this here, I would be down $106 because I didn't want to pay taxes. That sucks. So basically, instead of having 705 minus 30, so 705 minus 30, oh, I should need to do equal sign, equals 705 minus 30. Instead of having this much net after taxes, I would have 510. I would have 510, which means I would have this minus this. I would have a resulting value of $164 less in my account per share. which ultra blows. Which ultra blows. So for me, I'm going to pay taxes all day because that means I'm making money. I'm making money. And so that's why I would do that. That's why I would do that. So to that point, I would look for the 10 EMA to get out. But of course, there's lots of other signals you could use to get out. That's just one of them. And then another question. The problem with buying the dip is that you never know how much longer it's going to keep dropping. Cisco is one of the most extreme examples. It reached a peak in the early 90s or the early 2000s, late 90s. It dropped for 2 years nonstop. 25 years later, it's not recovered in price. How long are you willing to buy the dip? I think that's such a great point. We can go look at this CSCO, and we can go to the monthly charts. And right here, right? It peaked in March of 2000 at $82. We're 25 years later and it's at 53. Yikes. Big yikes. Big yikes. But you have your 10, 20, 50. I'm not going to scroll all the way back. You have your 10, 20, 50 crossover, and you'll know exactly where the trend has changed. You'll know exactly where the trend has changed. Where you can ride a long trend up like this, pay your taxes, and get out before you start losing money. For sure. Okay, so also want to showcase in our Discord the share your big wins. This question right here, or not this question, but the statement from K Silver. I hope you're watching this live, K Silver. Wasn't about dollar amounts, just understanding how to play and no mo FOMO, right? So first off, he said, I made a plan and I carried it out. He bought here this morning. He sold here right near the top. And now look at it, right? It's not about the dollars. It's about following the plan. K Silver is here. Dude, this is awesome. Congratulations to you. This is the kind of stuff that I love to share because he followed his trend. He sold out at the top by his plan, which kept him out of this big move down. And you know what, Kevin, you're going to have to pay taxes on that, dude. Hope you don't mind. Hope you don't mind that you're going to have to pay taxes on the fact that you have more money in your account, right? I'm on the bandwagon of pay as much taxes as you possibly can because that means you're a badass trader. So Kevin, congratulations on being a badass trader. So let me go back over here real quick. So be sure to share your stories in the Discord. And of course, the first rule of Outlier is you tell everyone about Outlier and you hit the like button. That lets YouTube know about it as well. Now, real quick, what is Outlier and how does it work? Well, old Uncle Warren used to say, be fearful when others are greedy and greedy when others are fearful. Outlier shows you if investors are acting rationally fearful or greedy and by how much, allowing you to get into the stock before the Outlier move happens. And if you're ready to save time, make money, and start winning with less risk, head on over to outlier.com and you can get the annual plan for just 82 cents a day. Or if you're on the monthly plan, you can upgrade with one click and save 64% in the process. So in my style of trading, I'm going to be locked out of the market because we do have a buy signal on the SPY. And that's okay, because to me, I read that as a buy to close the short. So if I go to the watch list and I go to the SPY, we can see it's sitting on a buy signal right now. Now, a buy signal within a downtrend is, in my opinion, a buy to close your shorts. Now, of course, it continued on further than that. But anytime you see a buy signal within a downtrend, that's the way that I'm going to read it. So next, the market trend, as we talked about, is very, very bearish. Market breadth is really interesting right now because if we go look at the watch list over here, market breadth measures how many stocks we have buy signals for on our bull list versus how many stocks we have sell signals for on our bear list. You can see we got one new buy signal today versus 48 new sell signals today. And that buy signal came on OKLO. And if we go over the market breadth, you'll see just how fast this is falling. Now, market breadth is measuring how many stocks are having buy signals, which are going to help push the market up higher. And you can see we've got a crossover point just a couple of days ago. So we have a bearish trend, bearish market breadth, a bullish signal. It's not in confluence here, so I wouldn't even be looking for any short positions, and I certainly wouldn't be looking for any long positions. But lately, with the new Outlier 3.0 signals coming through, I can't tell you how excited I am. So whenever Mahesh gives me that data, I'm going to be doing a lot of back testing, and I'm going to be showing you these results right here on the screen with the new Outlier 3.0 signals. But not only that, I'm going to make sure that the master key is uploaded, upgraded, and awesome and ready to go for 3.0, and I can't wait to see just how great these are going to be. So let's see again if there's any other chats that I want to catch up on. Cisco is the Walmart of IT. You can get discounts on new gear, but it's not really all that good. Let's see. Guinea pigs are cool. Hey, Texas, could you touch on video about how you budget as trading doesn't provide an exact weekly income? How would you not overspend when you're out of the market? I have no idea. So I trade for capital efficiency, and I'm the last person, the very last person you're ever going to see say, oh, you know what? We're going to be making $8,000 this month, $25,000 this month. I just made $38,000 on a single trade. No. That's Scamville. No. That's Scamville. First off, you have no idea. And in fact, this is not any sort of criticism. This is a lesson to everyone. You don't know when you're going to get paid in the market. You don't know when you're going to get paid in the market. And I just want to showcase my returns from last year, which is not the first time you've seen them. I know. But the point here is to show that, first off, we don't know when trades are going to set up, right? We don't know when they're going to set up. And we don't know how much we're going to make when they set up. Because for me, I had a 91% gain last year, which was more than enough to live on. I'm going to put it to you that way. Way more than enough to live on. But I traded in May, July, August, September, October, and I lost money in November. Okay, first off, we don't know when the trades are going to set up. We don't know how much we're going to make when they set up. And if you are saying that you have to make X amount of dollars weekly or monthly to get by, and you're basing your lifestyle on your trading returns, that's going to be incredibly stressful. And it's going to give you a different anxiety level, a different, what's what I'm thinking of? Different anxiety level, a different behavioral level when you take these trades, because you're now looking to say, oh, I have to make this trade so I can pay my mortgage this month. Oh, I have to make this trade so I can send my kid to preschool. Oh, I have to make this trade to cover the health insurance, versus let's see how much I'm going to make this month. Let's see how much I'm going to make this year. Right? That's a very different, very, very, very different process-based versus outcome-based, process-based versus outcome-based decision on that. So listen, I want you all to know that I want to know what you're trading in the chat. And of course, if you're an influencer of any size, we want to work with you. So send us an email over at support@outlier.com and come back tomorrow where outliers like us will save time, make money, and start with less risk together as a team. YouTube is going to pop up a couple recommended videos. I recommend you watch them, and I recommend you have a fantastic afternoon.